All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. Last trading day of the week. It's quadruple witching here today in the markets. And, well, we have the backdrop of what the markets have been and where the implied volatilities are and just how much movement is happening here. You can see that today we get the since the market open right about here. We saw a modest drop, and then we saw about a 40-point pop here, 35 points, 37 points, somewhere in that area. This happened as comments from a Fed governor, Williams, and he talked about the Fed may need to change their stance going into 2019, and that neutral policy may not work. And I think it's one of those where the market looks at that and goes, "Oh, wait, okay, maybe the Fed is going to recognize the risk," because that's one of the disconnects right now, right? Is the market doesn't believe that the Fed really understands the risks that the market is seeing. And the Fed uses employment as a big metric, uses a lot of other things, but employment is what they're always commenting on, and the market knows it. Well knows employment is a very lagging indicator when it comes to economic expansion and contraction. And so, to hear that from the Fed, gave a little bit of boost of confidence. But like any rally that we see in this market, it was sold off, and we saw the market drop here, 45 points in the subsequent hour, right? And here in the last few minutes, we've seen the market rally 20 points. You say, well, those are big moves. Nah, you look at it in the context of yesterday, and yeah, okay. It's about the movement we've been seeing in this market, and I don't think the moves are done today. We're headed for much more movement here today, and that is the nature of what this market is right now. When I went out this morning and looked at some things, I had some short-term buy signals on a couple things. And, in this market, short-term buy signals can turn to sells very quickly, in a matter of a half an hour. But one that I got was here with Las Vegas Sands, and the hourly, jumped up above the 7-hour, and there was some decent action in the indicators. And I went out, and I wasn't serious about wanting to go buy it because of what the conditions are in today's quadruple witching. And one of the things that just happens on quadruple witching is the technicals kind of just in the short run, they don't have anything to do with anything for the most part. And so I went out, and I said, I'm going to go take a look at the options on this because this is something I like to trade. I've traded a bunch personally here this year, and went into the option pricing. And, Las Vegas Sands tends to have, spreads that are, a little bit elevated, right? They get into the 4 or 5% area when it comes to the spread between the bid and the ask, that difference between these two prices. And, you can see what the spreads are. 218 to 243. Wow. I mean, we come in a little bit more, 175 to $2. They haven't even compressed here so far today. They haven't even compressed. We go out to a monthly where the spreads are normally a lot smaller. It's 10 cents here. We're talking about a pretty hefty spread still. And that is, that's the case for Vegas Sands. And for many other stocks here today, the spreads are higher than normal for many. And, that's something that we will tend to see a little bit on OPEX or quadruple witching, but I think it has much more to do with the market. And basically the market makers say, look, we got a market that's moving huge. We're not going to get caught here. And so they open up those spreads, and because of the volatility, and, rightfully so. But we don't see a lot of implied volatility dropping today. The VIX is down about 2 points, but in terms of just individual stocks, we don't see big declines in implied volatility coming into play here just yet. And then this morning's rally, when you look at what rallied, you look at the breakdown. This rally has been led by utilities, which are up big here today. They've had a real rough week, and they're snapping on back. And consumer staples, right, which has had a really rough week and is snapping back. And these are the leaders here today. And what do we know about markets where staples and utilities are the leaders? Well, that's not aggressive buying. That's simply that's simply some forced rotation. And, that's what we're seeing here. When you look at, tech, it's lagging here today. Industrials are lagging here today. Transports, they've bounced. There's some areas of bounce here in it, but they're lagging. The utility and staples sector. Consumer discretionary is doing all right. It's well off its highs, but it was surprising to see it up the way it was, even with Amazon, down. And, Amazon's a big weight when it comes to the XLY, but you can see stocks like Walmart really snapping back, sizably today after yesterday's rout. Target snapping back a little bit after the rout this week here on it. Coming in, but a very conservative type of sector spread here today, a very what would be considered, a bearish spread. And you look at small caps, and they continue to erode, and they just continue to lag and underperform as money just is flying out of them. This December month, when we look at money flows here in the month of December, this might be one of the most bearish money flow months that we've seen in IWM in years. Not just months or weeks, but in years that we've seen this much of a bearish flow when it comes to the IWM. Now, in terms of its performance relative to the SPY, small caps versus large caps, you can see that, small caps are still lagging large caps, but they're not in that kind of 5% differential that says, hey, you know what? This metric is really oversold. Generally when you look at small caps versus large caps, if there's a 2% differential over about a 30-day period, it tends to be telling. It tends to be either bullish or bearish. In this case, bearish, because IWM is lagging the SPY by about 4%, right? And we've touched on this. We've talked about this many times. And then when it's a 2% differential or less, either way, it's pretty neutral. When small caps are outperforming large caps by more than 2%, that's pretty bullish. But once you start to get into the 5-6% area over a 30-day period, you're getting into real extremes. And in this case, it would be a very oversold extreme. And if there's that 5% differential, and it's only about a 4% differential, and there's no exact science to this number where you go, well, if it's 5.21%, but it's somewhere in that kind of 5 to 7% area is where we really see the oversold nature, and we see the performance of small caps really snap back relative to large caps. But it's not there yet. It's not there yet, and there's no sign that it's going to come in here, today or anytime real soon here. So that's what we're seeing in that. So very, very conservative spread here on the day. Now, one area I've talked about wanting to be a buyer, wanting to get some exposure in is the EEM, FXI, emerging markets. And they've had a down week here this week, but nowhere near to the same degree as the S&P and the U.S. markets here. But we've seen some very heavy volume in the EEM over the last 2 days. Some of that's just a product of the overall elevated volumes in the entire market. And this is one that I was looking at today. You can see it went up, touched the 7-day moving average. Hasn't been able to break above it. I do have an order ready to be a buyer, but haven't filled the order, haven't stepped in and bought it here just yet. When you look at it from an hourly standpoint, you can see it, recapturing the 7-hour moving average. And you can kind of see the volume elements that are in play here. And so there's some bullish technicals, especially around some of this support level that has been building in here for the EEM. But I do have to be careful because of just general market conditions and the fact that they're lower highs as we're getting down to this level. So sure, it might bounce here, and we could be talking about it pushing into full, the 39.5 to 40 level. But the overall breakdown risk I still think is relatively high. If we were to see the market metrics switch and flip, where they would go, bullish, then I'd be a lot more interested in saying, okay, let's go, and jumping into EEM and feeling really good about jumping into that here. But so far today, just very little, if any, to really give a lot of bullish confirmation or bullish hope. Me, I expect that we'll see some volatility compression start to come in to the markets, but I do think it's very telling about what the market thinks about things today. The VXX is higher, the VIX is lower. You don't see this very often. Okay, this isn't something that you see happen every day. But when it does, generally we're what's happening are VIX futures are in what's called a backwardation phase, where they're actually more expensive the longer you go out. And so the market is not pricing in a volatility contraction in the future like it normally does. The market's actually pricing in more volatility into the future here today. That's what it's doing today with the pricing. Now, it is quadruple witching, so I'm not going to read too much into that, but that is what we are seeing happen here with the VIX, with the fear, the fear element, so to speak, there, and more importantly, option pricing, right? Option pricing, in general. And while yes, the VIX isn't based on what option prices are, we know that option prices are significantly elevated when the VIX is higher. And so while yes, I suspect that we will see volatility compression, I don't have enough there for me to go out and want to play it or play it aggressively, here today. So, with the cash I have for the challenge, I have to have something, really solid, really, really strong here for the next trade. I just can't, I have to be a little bit, I have to play the odds higher, right? Most trades, I look at 50, 60% odds. That's about where they are on most times. That's what, with the technicals and everything else, that's about, with short-term options, that's about what I expect. But right now, I need 70, 80% odds on the next trade here. So I don't have those. Even with Las Vegas Sands this morning, I couldn't look at it. I couldn't look at what was happening with the price action and say, man, I have 70, 80% odds. No, it was about 50, 60%. And, that's not where I want to be. And that's where a lot of things are in the market here today, even on some of their, modest bounces. Now, in the stream here this morning, I made a comment on Nike. Nike reported earnings after the bell yesterday, and while price action after earnings, you hear me say it all the time, doesn't necessarily indicate what's going on with the company or the stock. We see, flip-flops all the time. In the case of Nike, I think it's very telling. And, we have a market right now that is very worried about 2019 and the growth prospects here in 2019. What the revenue growths are going to look like from transports to material stocks to retail names, and the market is very concerned. That's one of the big catalysts for the correction that we have seen. Now Nike reports earnings, and they come in with some decent numbers, but there's a theme here. And it's opposite to what the market worry is. The market worry is growth or revenue deceleration, right? They're not worried about recession, though some people are throwing that number out, but it's deceleration of growth, right? Looks like this. Here's your revenue growth. It's going up, it's going up, it's going up, but starts to slow down how it goes up. That's decelerating growth there. Okay. Market's very worried about this because it's the first step towards falling growth or recession or contraction, right? That's what the market's concerned about. Well, one of the things that's going on with Nike is the curve is actually looking a little bit different. They're starting to show signs of accelerating growth, of that growth actually picking up. You can see how different those curves look from what the market, from what the market worry is about most things, and what Nike's starting to show. And we've talked about the turnaround story in Nike this year many times. And yes, it's gotten sold off with the correction, just like everything else, but it's a very different story. Analysts jumped on it this morning, very positive about things with Nike. I do think this bodes very well for Under Armour going forward. I think it bodes very well for Foot Locker going forward, both of these names. Now you can see Foot Locker is gapping up here, fresh move above the 7-day moving average. An analyst, I believe it was JP Morgan, specifically mentioned Foot Locker after Nike's earnings and it being a benefit to Foot Locker. But I think it's a benefit to all three. Now I'm not willing to buy any of them today. They still have the earnings to shake out and all of that. But you go and you compare this to a Micron earnings, to a FedEx earnings that we've seen, even an Oracle earnings. And Oracle earnings were okay. They were pretty decent. You can see Oracle gap up big on their earnings. So much for that, right? But they were decent. But Nike very different from all three of those. As all three of those, you can look and say Micron, FedEx, Oracle. Man, there could be a growth slowdown in 2019. With Nike, it's looking like, wow, there's actually going to be an uptick in growth here with some of the changes they have made, with some of the direction the company is going, and so it's it looks pretty darn good. So a very different type of report here out of Nike than what we've seen out of others, and I do think this earnings season that we will go into in January is going to be one of the most important earnings periods for the market in a long time. And there are probably going to be more companies out there, maybe even to the tune of 80% of the companies out there that are downbeat on growth in 2019. Those companies are going to kind of be with the herd, with the market. And I don't think there's going to be a lot of differentiation with them, right? They're going to go down with the market. They're going to go up with the market. The ones that come out and actually talk like Nike did, or show numbers like Nike did, they're going to be pretty big outperformers in 2019. And I think that's what Nike's earnings say. Now, Nike could still fall apart here in 2019. The stock could still go down 20%. If the market drops huge, Nike's not going to hold up. Right? It's not like it's not good enough to withstand a huge market drop. Now, if the market goes down 20%, Nike's probably down 10 to 15%. Right? It's probably going to outperform the market overall. But outperforming the market doesn't necessarily mean going up. And I think that's what has to be kind of differentiated and understood about, Nike's earnings and what it means for Nike, what it means for Under Armour, what it means for Foot Locker is they are likely to outperform the market. But being a buyer of them, you generally going to want to be a buyer when the market is a little more turned or stable, or on much more of a bullish bounce than in some of the heavily bearish situation that it is right now. Thanks for hopping on. Have yourselves a great one, and we'll talk to you later. Take care.